Most people enter trading with a dream in mind. The idea of making money every day, quitting their job, and trading from a beach somewhere sounds perfect. But what almost nobody tells you is this: you will lose, and you will lose often. Not because you're unintelligent, not because the market is manipulated, and not because you are missing some secret indicator. The truth is, you lose because you are playing the wrong game. When you truly understand how trading works, it becomes clear that this is not a game for those who win the most trades. Instead, it rewards those who know how to manage losses properly and remain in the market long enough for their edge to play out. Welcome back to the ComLucro channel. In this video, we break down how professional traders think about losses, why most retail traders fail, and how you can completely reshape your mindset to join the small percentage who actually survive. So, if this type of content is valuable to you, remember to like the video, subscribe to the channel, and enable notifications so you don't miss the upcoming lessons. And feel free to share in the comments which topics you would like us to explore in future videos. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to continue producing this kind of educational content. Now, let's take a step back and talk about how most traders actually begin. In the early stages, they approach the market with a strong sense of expectation. They believe they will outperform the market, achieve financial freedom, and win the majority of their trades. The underlying assumption is very straightforward. If I am skilled, I should rarely lose. So when the first real drawdown appears, when they go through 3, 4, or even 5 consecutive losses, they quickly assume that something must be wrong. They begin to believe their strategy is broken. Then the thoughts become even more destructive. Maybe I'm not made for this. Other people are winning, so why am I not? The reality, however, is very different. Even world-class traders can have low win rates. They may only win 40% of the time, but the way they control their losses keeps them alive. And the way they let winners grow makes them consistently profitable. That gap between expectation and reality is exactly where most trading accounts disappear. If you think about it visually, the expectation is to win most trades, while the reality is to lose often but win intelligently. This is where the mindset shift begins. Trading is not about avoiding losses, it is about controlling them. Professional traders are not trying to predict the future with certainty. They do not need to be right all the time. Instead, they think in a very structured way. If I'm wrong, I want to be wrong small. If I'm right, I want to be right big. The real job of a trader is not prediction, but risk management in the present moment. So instead of constantly asking, how can I win more? Start asking a better question. How can I structure my trading so that losses are small, planned, and almost boring? How can I build a system where a few strong winners easily cover many small losses? Once this becomes clear, your entire approach changes. You stop behaving like a gambler and start thinking like a casino. And if you have ever refused to close a losing trade, you already understand the emotional struggle behind this. You tell yourself, it'll come back. It's just a temporary move. Maybe I will move my stop a little further. Underneath all of that behavior, there is a simple truth. We hate admitting that we are wrong. Closing a loss feels like failure. It feels like locking in pain. So the mind starts negotiating with reality. If I don't close it, it's not really a loss yet. But your account does not care about your ego. It only responds to math. The traders who survive are not the ones without ego. They are the ones who have built rules strong enough to prevent their ego from taking control in critical moments. And the situation becomes even more difficult when you look at social media. All you see are screenshots of huge wins, 300% gains in a week, turning small accounts into massive ones, and perfect equity curves that only go up. What you almost never see are the months of sideways movement, the long drawdowns, and the accounts that were completely lost and never shared. As a result, your brain starts building a false belief that real traders win all the time. So when you experience losses, you begin to think something is wrong with you. This is a very dangerous illusion. In reality, professional traders take many small and uneventful losses. They go through long periods where nothing significant happens, and most of their profits come from a small portion of their trades. Their profit and loss curve may look messy in the short term, but solid risk management and proper math keep them alive over the long term. Now, let's talk about something that most new traders completely ignore. It is called expectancy. The formula is simple. Expectancy equals win rate multiplied by average win minus loss rate multiplied by average loss. If the result is greater than 0, your system is mathematically profitable over a large number of trades, assuming you survive the natural ups and downs. If it is below 0, your system is slowly draining your account, no matter how confident you feel about it. The problem is that most traders never calculate this. They do not track their trades. They do not know their real win rate. They have no clear idea of how large their average loss actually is. In other words, they are trading without visibility. Professionals, on the other hand, focus much less on individual trades and much more on this long-term equation. To make this clearer, let's compare two traders. Trader A wins 70% of the time. Their average win is plus 1R, and their average loss is minus 3R. Over 10 trades, that means 7 wins equal plus 7R, and 3 losses equal minus 9R. The result is an expectancy of minus 2R over 10 trades. It looks like a high win rate strategy, but it is slowly losing money. Now consider Trader B. This trader only wins 40% of the time, but their average win is plus 3R, while their average loss is minus 1R. Over time, this structure creates a completely different outcome. Looking at the numbers, Trader B takes 4 wins at 3R, which equals plus 12R, and 6 losses at 1R, which equals minus 6R. The final expectancy becomes plus 6R over 10 trades. This trader loses more often than they win, but the math is clearly working in their favor. So who actually survives in the long run? Not the trader with the highest win rate, but the one who consistently keeps losses small and allows winners to grow. If your goal is to build a trading approach that truly survives, you do not need 100 different indicators. What you need are 3 strong pillars. The first is your method, a clear, logical, and testable system that defines what you trade, when you enter, and where you exit. The second is risk, meaning how much you are willing to lose per trade, per day, and per month before stepping away. The third is psychology, which is your ability to follow your rules even when you feel fear, greed, or frustration. When you neglect any one of these pillars, the results become predictable. A great method combined with poor risk management leads to blowing up your account. Strong risk control without a real method turns trading into random gambling. And even with a solid method and proper risk, without discipline, execution breaks down completely. Your objective is not to be perfect in one area, but to be consistently solid across all 3. Most traders fall into a very common 3-stage trap. During the first year, trading is driven by emotion. Decisions are based on tips, news, and social media hype with no real plan and no consistent stop losses. Every trade becomes a guess. In the second year, there is the illusion of knowledge. Traders start learning indicators, patterns, and complex terminology. Their charts become cluttered with multiple tools, and although they feel more informed, their results remain inconsistent. By the third year, the focus shifts to blaming psychology alone. At this stage, traders begin to say their main problem is mindset. They try to stay calm and disciplined, but their system still lacks a proven edge, and they still do not understand their own expectancy. Mindset is important, but it cannot fix a system that is mathematically unprofitable from the beginning. You need both a positive edge and the discipline to execute it properly. So the question becomes, how do you move toward the top 10% who stay in the market for years instead of months? The first step is to accept that losses are part of the process. A losing trade that follows your plan is not a failure. It is simply a business expense. The second step is to define your risk framework. Decide how much you risk per trade, what your daily or weekly loss limits are, and at what level of drawdown you stop and review your performance. The third step is to choose one simple and clear strategy, not multiple strategies, but one. From there, define your market, your time frame, your setup, your entry, your stop, and your target. The fourth step is to backtest your approach and calculate expectancy. Gather between 50 and 100 sample trades, then measure your win rate, your average win, and your average loss. If your expectancy is negative, adjust your system before risking more capital. The fifth step is to trade small and focus entirely on execution. At the beginning, use very small position sizes or even a demo account. Your goal is not to make money immediately, but to build the habit of following your rules consistently. Over time, you can train yourself to improve how you handle losses. There are a few powerful exercises that can help accelerate this process. The first exercise is to define your loss before entering a trade. Say it out loud. If I am wrong, I will lose a specific amount or percentage. This forces your mind to accept the risk in advance. The second exercise is the 20-trade challenge. Choose one setup and commit to taking 20 valid trades following your rules, regardless of the outcome of previous trades. This approach trains you to think in terms of a series of trades instead of focusing on individual results. The third exercise is to journal your emotions after each trade. Record not only the outcome, but also how you felt and whether you followed your plan. The fourth exercise is to celebrate well-executed losses. If you took a loss that followed your system and respected your risk, mark it as a success in your journal. This helps reprogram your mind to understand that losing correctly is part of winning over the long term. In the end, the key idea is simple. Trading that works is not exciting, dramatic, or heroic. It's about repeating the same proven setups, respecting your risk every single time, taking small and controlled losses without emotional reactions, and allowing a few strong winners to run. You do not need to be the person who predicts every top and bottom. Instead, you need to be the trader who stays in the game. Don't aim to become someone who never loses. Aim to become someone who knows how to lose well. Because over hundreds of trades, success does not belong to the most dramatic trader, but to the one who is still standing. Please also remember that the mission of the ComLucro channel is simple. Our focus is to help traders develop clarity, confidence, and structure, so every decision in the market is made with discipline and clear intention. On this channel, you will find complete courses designed as a true trading masterclass. We teach the liquidity concept in trading, the complete guide of market structure, higher time frame analysis, and supply and demand trading strategy principles, always focused on understanding price behavior and executing with a professional mindset. We also explore trading psychology, risk management, and long-term consistency. Because trading is not only about charts, it is about mindset, discipline, and structured execution over time. There are no shortcuts in the markets. Real progress comes from continuous study, observation, and practice. Our main courses include smart money concepts, ICT concepts, technical analysis for day traders, trading psychology, and the Wyckoff method course. Alongside these courses, we share lessons and insights from some of the most respected names in trading, including professionals like David Paul, Alexander Elder, Tom Hugard, Francis Hunt, and Mark Douglas, whose work has helped traders better understand the structure of financial markets. So, if this video helped you gain more clarity, leave a like. It helps this content reach other traders who are also working on how to become a successful trader. Make sure to subscribe and turn on notifications so you do not miss our latest trading psychology masterclass lessons and deeper insights about the markets. Now, I would really like to hear from you. Which concept in this video made the biggest difference for you? Or what topic would you like us to cover next? Leave a comment below and let us know. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro trader community right here on YouTube. It is a simple way to support the channel and a smart investment in your own growth as a trader. Thanks for watching, and I will see you in the next video.